Ever wondered why gold prices are absolutely exploding right now? Gold jumped over 50% in just 2 years, reaching highs around $5,592 per ounce. But today it's corrected to about $4,995. So the big question is, will it keep going up or is this rally about to burst? A lot of people point to geopolitical uncertainty. Think wars in Ukraine and the Middle East, tensions over Taiwan, and trade spats shaking the world as the main driver, pushing folks to gold as a safe haven. But is that the only reason, or is there way more bubbling under the surface? Like currency wars, inflation fears, and central banks hoarding it like treasure. Today, we're breaking down what's really driving gold's wild move, whether this rally still has legs, the forces at work beyond just geopolitics, and the risks most people overlook. If you're looking at gold as a way to protect your money in times like these, hit subscribe, tap the bell, and let's dig in because understanding this could make a real difference to your wallet. Alright, team, let's keep it straightforward. Why the hype about China potentially becoming the world's top economy? It's not fluff, the data screams it. Think of the US like a household drowning in bills. By 2025, national debt has crossed $35 trillion, dollars, more than 120% of GDP. Basically, more than the country earns in a year. That kind of burden weighs heavily on everything. China? They're playing in a different league, pouring massive resources into growth engines like factories, infrastructure, and cutting edge tech. Yes, their debt is high too, around 300% of GDP when you include the hidden stuff. But a lot of it is still driving real, tangible progress. If the US doesn't move fast, China could seriously challenge for the top spot. And the numbers are eye opening. Energy comes first. It powers everything in the modern world. China generates more than twice the electricity we do, over 10,000 terawatt hours a year, compared to roughly 4,300 to 4,500 in the US. That's like powering two whole US economies. No energy edge means no winning in tech or industry. Manufacturing really seals the deal. China now controls about 30% of global production, according to World Bank data, while the US sits closer to 15 to 16% and slipping. In electric vehicles and renewables, they've moved ahead. Companies like BYD are already outselling Tesla in key markets. This isn't about catching up anymore. In these areas, China is already leading. And that's setting the stage for a currency showdown, where gold tends to shine as the go-to safe haven when confidence in the dollar starts to wobble. Your output. Only tags are added where appropriate. Relax. The US has a proven strategy from the past. Flashback to 1985. Japan was the threat then, mirroring China today with cheap exports and a weak currency crushing our markets. In the mid 1980s, the world's top economies, the US, Japan, West Germany, France, and the UK, quietly met at New York's Plaza Hotel and agreed to weaken the dollar. The result? The yen surged nearly 50%. Japan's exports were hit hard, helping the US regain competitiveness and narrow trade gaps. But Japan paid a heavy price. Asset bubbles inflated, then burst. Markets crashed around 1990, and what followed were nearly 3 lost decades of economic stagnation. Today, Plaza 2.0 chatter is rampant in finance world. The target is clear: force China's yuan higher and squeeze its $3 trillion export machine. China isn't standing still though. They've been unloading US Treasuries by the billions and quietly building gold reserves. Officially 2,303 tons by late 2025. But here's where it gets interesting. Reports from Nikkei Asia and estimates from ANZ suggest the real stash could be far larger, closer to 5,500 tons, more than double the official number. If that's true, China would leap to become the world's second largest gold holder, trailing only the US, which holds over 8,000 tons. This massive accumulation isn't random. It's part of a bigger strategy to secure independence in a divided world. This hoarding is no accident. In currency wars, gold explodes as a neutral, safe currency alternative, untouched by government whims. It's why prices are blasting off more on that soon. Okay, this sounds intense. But how does it hit your life? And why is gold the star here? If a Plaza 2.0 kicks off through tariffs or market interventions, China's exports could stumble. But a weaker US dollar? That's a double edged sword, and it cuts you first. Prices on imports, electronics, food, fuel skyrocket, fueling inflation and eating away at your savings. It's a harsh reminder of the 1970s when everything cost more and economic growth hit the brakes. All this chaos is fueling gold's surge as a safe haven currency. In just 2 years, it's jumped over 50%, hitting record levels around $5,380 to $5,500 per troy ounce in early 2026. So, why the gold boom? When currency wars shake trust in fiat, like the dollar under devaluation, gold stands out as a timeless store of value. You can't print it or manipulate it. And history proves it. After the 1971 end of the gold standard, prices quadrupled amid dollar weakness. Even Plaza 1.0 realignments triggered massive surges. Gold benefits from even more. Inflation erodes cash, making gold a hedge. Low interest rates help it outperform bonds. And whenever geopolitics heat up, Taiwan tensions, wars, it sparks a rush into safe havens like gold. Central banks, especially China, scooped up over 1,000 tons of gold in 2025 alone, moving to diversify away from dollars. Supply is tight while demand is soaring from jewelry, tech, ETFs, and nervous investors worried about currency debasement. In essence, gold is your shield in this currency war, a safe haven when others falter. And if the dollar ever loses its reserve status, some models see gold potentially soaring to $39,000 per ounce. But it's not all upside. Up next, we'll break down the risks you need to watch. The US China dynamic isn't happening in a vacuum. China's Belt and Road Initiative links over 140 nations, and their digital yuan is challenging dollar dominated systems. Our $1 trillion a year in debt interest? That's even bigger than defense spending, a real vulnerability. Today's tariffs feel like mini plaza interventions. China responds with commodity acquisitions and pushing the yuan, cutting their treasury holdings below $700 billion, nearly half of what they used to hold. Now just 2% of the US's $38 trillion public debt. They're clearly concerned about US credit risk. In fact, for the first time, ANZ estimates China's gold reserves could now be worth more than their remaining US Treasuries. But it's not just gold. Since 2011, China's been on a massive mineral hunt. Oil, gas, copper, uranium, rare earths, you name it. State giants like Zijin Mining are hiring thousands of experts in metallurgy, geology, and mining to accelerate the push. Analysts see this as preparation for a two-block world where China secures physical resources to call the shots. Even India is following suit, cutting US Treasury holdings nearly in half to boost gold reserves, treating it as a tough hedge against inflation and crises, even though it doesn't pay interest like bonds. Your output: as dollar risks rise, gold remains the safe bet. But it's not without pitfalls. Volatility can be huge. Gold can drop 10 to 20% during rate hikes or calmer periods like in the 2022 corrections. There's also the opportunity cost. It doesn't earn interest, so you miss out on stock gains in boom times. Physical gold comes with storage and theft risks, plus the danger of fakes. Regulatory changes like taxes or bans during crises can also hurt. And yes, Market manipulation or bubbles are possible when hype drives overbuying. Liquidity matters too. Selling large amounts quickly could force losses. The takeaway: gold is powerful, but it's not foolproof. Diversify smartly. What if the dollar drops 20 to 30% in value? Everyday costs would rise, export jobs might benefit, but those on fixed incomes would take the hit. That's why some turn to gold, silver, or even Bitcoin. Just be aware of the risks before diving in. Looking ahead, there's a real chance the yuan comes under pressure after the 2026 elections. If that happens, gold could surge sharply, possibly reaching around $6,500 by mid year. Over the longer term, if BRICS nations move toward a gold linked currency system, prices above $8,000 are not impossible. That said, this isn't a one way bet. The United States still has a powerful wildcard: innovation. Breakthroughs in AI, green energy, and productivity could completely change the trajectory. But one thing history keeps reminding us: gold always survives. From the fall of empires to periods of hyperinflation, when paper currencies fail, gold remains. China's dominance in energy, manufacturing, small, and gold stockpiling sets the stage for currency clashes. US plaza tactics could counter, but risks mutual pain. Gold's exploding as the safe currency refuge amid devaluation fears, a protector when dollars weaken. Yet remember the pitfalls: sharp drops, no yields, external threats. Key reminder: gold's timeless allure shines in uncertainty, but balance it with caution. Thanks for joining, Zalwora. If this sparked ideas, like, comment your gold risks thoughts, and share widely. Subscribe for more real talk breakdowns. Follow @Zalwora on X, Instagram, and Facebook for alerts. Disclaimer: this video is for educational purposes only and not financial advice. Markets are unpredictable. Past performance isn't future guarantee. Consult a qualified advisor before investing, as risks include total loss. Stay wise out there. See you soon.